So, Patti, I was really excited today to talk to Alexander Renzi from MAPP Advisors, who specializes in buy and sell side acquisitions. We've just really never had a conversation like this in the podcast before, where we're talking about growth through acquisition.
Mhm.
And if you think, well, I'm too small for this episode to matter to me, no, you're not, because you may be thinking when you listen to this, you may say, well, wait a second. Maybe I could acquire a portfolio in my local market. Maybe I should think about outside capital differently. So this is one of these episodes that I think is going to kind of expand your thinking if you haven't been thinking down the lines of acquisition and outside capital. I did this intentionally, kind of following, I'm not sure if it was the week after or closely following the interview with Dustin Magazine or about kind of more of the organic growth, because I really want to give our audience like a broad concept here,
Mhm.
Patti, of how to grow in 2023 and beyond. And
Yeah.
this episode is kind of more about the outside capital route.
Yeah, I think I found it very educational, and, when we first sat down to this interview, I was like, "Well, James, you can take the lead on this because this is a topic that just kinda, like, goes over my head." But I came away, with a pretty firm knowledge base, so I
Well,
I
good.
thank Alexander, and I think our listeners will have the same experience. And
Cool.
then, James, tell us about your, questions in the field.
Yeah, so I followed up with really a question that I should start. Some of these I think are more questions from the executive room or something, the executive, the
From
conference
the
room.
executive suite, right?
Yeah. This one is just talking about mapping out your version of success as it relates to outside capital and growth. And I don't know. I actually really enjoyed this one. I just kind of feel like um, this is such an important one. If you're thinking about growing, you need it within context of what are you trying to accomplish?
Right.
What do you want your life to look like? And so I think that was good. And then Patty, I really enjoyed yours. So talk about the BNPL stuff.
Yeah, the buy now, pay later market is just exploding, and I came upon some pretty esoteric research that really explains why merchants are clamoring for this. James, what do you say? Should we get going?
Let's go. All right, everybody. I'm here today with Alexander Renzi, and Patty and I are going to be talking to him. He's the managing partner over at MAPP Advisors, and we're going to talk about acquiring other companies. So we've talked a lot on the podcast about kind of growing your portfolio value, making yourself attractive to be acquired. But today we're going to talk about growth through acquisition. Before we dive into that, Alexander, we have to hear your story. It's very interesting. So tell us, how did you get into this crazy industry, and then what was your path to MAPP Advisors and kind of what you're doing today?
Absolutely. Well, first, thank you for having me on and congrats on the success of your show. You and Patty are always providing great insights for our industry. So really owe
Thanks.
you a debt of gratitude there.
Thank you.
I started out on the entrepreneurial side, probably like most of your listeners, about 10 years ago. I founded an alternative lending company. That company was acquired by one of our referral ISO partners, and I became the COO. We grew that company to about 12,000 merchants before eventually selling. I then started another ISO that was focused on the community and regional bank channel. And after selling that business, I joined my now partner, Jim Batista, who's also a founder in the space. Together, we run MAPP Advisors. We are a fintech advisory firm with a core focus on payments. Most of our engagements are helping founders sell their business. I think clients value that we were once in their shoes as opposed to most traditional bankers.
Sure.
We also have a large consulting practice. We work with everyone from the card brands, sponsor banks, ISOs, ISVs. Probably the most relevant consulting service for your listeners is our portfolio optimization practice, where we basically audit residual streams to identify savings. But love what I do, love the space. We have an amazing team and awesome clients.
Love it. Awesome. So this is a really interesting conversation. And again, one we haven't had on the podcast. And so I want to like clarify what we're going to talk about and then dive into the question. So again, for those of you that are listening, what we're talking about here is, you've got you have an ISO and you are looking to acquire another company, another portfolio, maybe a tech company, whatever it is, in order to grow and scale your business. So as you're looking at 2023, and this is a really interesting context because we actually just had a podcast, I think would have aired the week before this one with Dustin Magazine, where we kind of talked about the path to growth, where it's a little bit slower path using cash flow, growing organically. This is talking about growing through acquisition, where probably outside capital is going to come in and things of that nature. So I guess my first question for you, Alexander, would be, what are some of the reasons that you see specifically ISOs and payments related companies? Why are they looking to acquire as a path to growth? What are some of the key reasons that you see them looking down that path?
Okay. Yeah, I mean, this is an important question, obviously, for the buyer, but it's also something I encourage my sellers to think through when they go through the process. I think you really need to put yourself in the buyer's shoes to understand why they want your asset, and it usually helps lead to a positive outcome. But going back to the original question, I think the main qualifiers for acquiring a business are, one, to collapse time, and two, obviously, to create value. And both should be true for successful acquisition. So what does it mean to collapse time? The buyer has to really ask the age-old question, build versus buy. I think the most common example of that is scale. Let's say a seller has a portfolio of 1,000 merchants. Could the buyer go out and spend less money to directly onboard 1,000 merchants? Probably. But depending on how many deals you do a month, this could take 1 to 2 years instead of 2 months with an acquisition. Mm-hmm. I think two other reasons a buyer may need to collapse time is, for one, certain go-to-market strategies. Say, for instance, you do 1099 model and you want to establish an inside sales channel. It's a lot easier to buy one than to build one from scratch. The other, and the most obvious, is probably collapsing time on technology, like building a gateway. Could a buyer with no technology experience build a gateway from scratch? Sure, but it's going to take a long time. You're going to make a lot of costly mistakes. And then I think finally, going back to the creating value, seems obvious, but it must make sense financially. 1 + 1 better equal more than 2. Going back to the scale example of the portfolio, if you're buying a portfolio to double your business, but the cost is so high that it puts you in a cash crunch, you're better off not doing the deal and just building internally.
Yeah. That's a great segue to what I was wondering. Why should, I think you just answered this question of why should, a well-established ISO buy an ISV or other tech-related company. But I wondered if maybe you could dive a little bit deeper and explain how that can impact their valuation.
Absolutely. It can definitely go one of both ways, right?
Right.
I think on a macro level, an ISO would want to buy an ISV, quite honestly, to stay relevant. ISVs that embed payments continue to capture market share from ISOs. Sure. And most ISVs' business models are less inclined to offer reseller opportunities. So, going back to the buy versus build, building technology from scratch is really hard. If you're able to acquire a proven solution, it's a lot safer path to execution. You still have to execute, but you eliminate a lot of the early day fumbles. I think once you acquire an ISV, the great thing is you now have in-house technology. I think ISOs are very well positioned for that feedback loop with their sales team to help improve the existing product, and they're very quick to identify other opportunities. So if you have an in-house tech team, you can shift quickly and execute on those. The second part was, how does that impact valuation? Look, if you can successfully acquire and integrate with an ISV, you can drastically increase your valuation. You go from being valued on portfolio multiples to SaaS revenue multiples. That said, I've seen a lot of these transactions go wrong, right? A buyer could overpay, the tech and the sales teams have different cultures, so they might fight, or probably the most common one is you don't integrate the two businesses. What I mean by that is, let's say you buy an ISV that's focused on auto dealerships and you leave it off to the side and only 5% of your auto dealers are integrated. You won't see the lift in your valuation when you eventually go to sell.
Right.
Yeah,
let me ask you this though. One of the other interesting options we didn't talk about there is, strategic partnership. So talk to me about, just to kind of bring this into context. So let's say you're talking to an ISO CEO, right?
Yep.
They've got 10,000 mids and they're looking to grow. So why should they choose to buy a gateway, right?
Yep.
Versus going to a different, processor agnostic and using it in that way? What are the kind of the pros and cons of those two approaches?
Yeah. A lot of it comes down to valuation. I am a firm believer of trying the partnership route first. As long as you're not tying yourselves into things you can't unwind down the road, right? I think you get to learn through partners' expertise. And when you eventually want to either buy or build something, you have a better roadmap. So again, start with the partnership and then eventually turn to a buy. When you own your own product, the advantage there is you get to build however and whenever you want, right? If you're beholden to a partnership, you're beholden to their timeline, no matter how fast they say their, dev cycles are.
Right. So there may be features you see a big value in building a particular feature for maybe a niche you're going after, but maybe your larger partner doesn't see that. Right?
Yeah, and oftentimes if you're discovering a niche, the partner is incentivized to release that feature to the rest of its audience because they probably have a use for it as well.
Right. Right. Yeah, exactly. Yeah. So you may make a great suggestion and they might build that and then everyone gets the value and then it's all of a sudden not a competitive advantage. Yeah, I love that. And I think too, kind of the, aqua hire, do you see that coming into play, especially in terms of these verticals, as we see the increased verticalization? Do you see payments companies saying, well, like in your example, we want to go after auto dealers. We don't know anything about auto dealers. So maybe they want to, do an acquisition so they can get the CEO of the company, the entrepreneur that built that knows something about that. Are you seeing that as well?
100%. And I think that's going to happen a lot more in the next couple of years, given sort of the market environment. A lot of these software businesses aren't running with profitable unit economics, so they're going to run out of cash. And I think ISOs are very, very good at selling and managing cash flows, whereas most tech companies are not. So I think there's a huge opportunity that you're going to see sort of the merging of the two.
Yeah, that's a good point. So let's shift our focus a little bit. So, we've talked about kind of the rationale for making an acquisition. Now I should mention that we're recording this on December 19th because things change so rapidly here. But
Right.
my very, very loaded question that you may or may not be able to answer is, talk about the capital markets right now, whether it's investors, private equity, whatever it is, what's kind of the enthusiasm around these types of deals in our industry? Is there a lot of action still? Is it slowing down? Like, what are you seeing?
Yeah, we are in very, very strange times, and I'm sure this will be completely wrong by the time it airs. But where we sit today, obviously public equities have dropped drastically. Interest rates, are probably going to go all the way up to 5%. So it's very obvious we're going towards a recession. What's different this time is there's probably over $1 trillion in private equity and venture capital money that's sitting on the sidelines that still needs to be deployed. So what we've seen so far is the investors shifting from sort of a return to the fundamentals, kind of what I talked about a little bit earlier, but companies that were growing at any cost, companies burning cash just to grow without a path to profitability, they've gotten hurt the most. Mm-hmm. Companies with good growth that are making a profit, they're still fetching premium multiples. I think aside from financial metrics, the next biggest drivers are really integrated solution, no surprise there, but groups that have a proven ability to push out technology solutions with high adoption rates. Those ones are still, fetching premium multiples.
Sure.
So let's talk about some of these different avenues. And again, I think this is an area where a lot of those in our audience may have heard some of these kind of buzzwords financially, but they may not be really very familiar with them. I think it's interesting, Alexander. Like I talk about it all the time on the podcast, but I'm like generally appalled by the use of capital in the ISO community or lack thereof, I guess I should say.
Lack thereof, yeah.
Yeah. So I'm really excited to have this conversation because I want to kind of, give a little bit of an introduction to some of these concepts. So let's start with private equity, which seems to kind of be, I don't know, your thoughts lately. It seems to be kind of the main way our industry is going as far as outside capital. So I own an ISO, I've got 10,000 mids, and I really want to do something. Like I've got the next 7 years of my life mapped out where I want to build a huge company. I want to acquire other businesses. Why and how would I go private equity route?
I could do an entire segment about
right?
Private equity, but I think before listing the pros and cons, I think it's really important for your listeners to recognize that an entrepreneur has to make a fundamental shift once they take on outside capital of any kind, right? You go from the owner of your business to a shareholder in the business.
Right.
This means, you have to stop making decisions based on what's best for you because you have a fiduciary duty to do what's best for the business. For some founders, that can be a sigh of relief, right? You get to de-risk by taking some money off the table. You get firepower to grow your business. And some founders find being a founder is isolating, right? So having investors to think through strategy can be great. Some founders, their identity is so wrapped up in the company that any critical feedback feels like a personal insult, right? So it can be a really tough transition. I think before an owner takes on any capital, I would highly encourage them to create an informal board to at least see what it's like to report to somebody else. A lot of entrepreneurs, myself included in my early years, we started companies because we were horrible employees. Going back to private equity can be a game changer for your business if you partner with the right group. They provide obviously capital to grow your business organically and through acquisitions. And the good PE firms they'll help you with operations. They'll help you bring corporate governance. They'll do go-to-market strategy with you. And even some of the best ones, they'll bring you customers from their portfolio of companies. And then the cons, I mean, I think I hinted at it earlier, but it's misaligned incentives, right? The PE group's sole purpose is to maximize shareholder value. If that means choosing a path you disagree with and you can't dissuade them, whether right or wrong, right? Too bad for you.
Right. They absolutely will have a controlling interest in the business, and you will have a, some equity or potentially some kind of future equity option in an eventual role that they might do. And so I think the other thing to mention too, right, is private equity generally is looking at, 4 to 7 year time frame where they're looking to generally flip the business. So they kind of want to sprint. Initially, there's usually a really big sprint, and then they kind of want to get into this growth path. And then it's like, what, 5 to 7 years? Is that kind of what you're seeing? Then they're ready to flip it to the next private equity or the next buyer, basically, right?
Yeah, I mean, you bring up an excellent point, right? I think we get so wrapped up in the process on answering the questions of the private equity group that, founders and sellers don't ask the questions of the private equity group, right? So every group is very different. They all kind of sound the same at first, but understanding their investment time horizon, understanding what they think of the business in the space, talking to other portfolio companies that they have, I think is really, really important.
Yeah. Yeah. It's really interesting. Yeah. I had a conversation, with a guy that was running a private equity group, maybe a couple of months ago, and a consulting client of mine was looking at, doing a deal. And I had this really interesting conversation where I was having these perceptions about what they were thinking and the strategy they were talking about. And I was like, I don't understand where you're going with this. Why are you doing this? And then finally he's like, now, I don't know if he told you, but our private equity firm is actually family owned. We don't look to sell. It's a long-term hold. And I'm like, oh, well, I didn't know that. That totally changed, because they were looking to make long-term investments. So I think that's right. Like you say, it's super important to understand, like private equity just means it's not public money. I mean, that could mean anything. There's kind of the stereotypical PE fund, but there's a lot of edge cases, around that.
Completely.
And also the thing, as Alexander said, I mean, when you go that route, and actually when you go almost any of these routes we're going to talk about, you go from being an entrepreneur to being an employee.
Right.
And that's a big, especially I feel for people in the ISO community, that's a big leap for a lot of people to make.
Yeah.
Not easy.
Yeah, it's not. And I think what I found, and Alexander, I don't know if I'd be interested to hear your thoughts. I mean, what I found is, especially with the PE side, while they are going to come in and add a lot of controls and a lot of constraints, at the end of the day, it is still very much a performance-based environment. And by that, I mean, you come in and you're killing your numbers and you're doing fantastic and everybody's making money. You are still running your business. You're the CEO of the company. You have a lot of help, but the difference is you can't just start losing money. You can't just decide I'm going to disengage for 6 months and take my family on a cruise across the world. You can't do that anymore because you have a responsibility to hit certain numbers.
Yeah, I'd say 9 out of 10 private equity investors, their goal is not to run your company, right? They would love for you to give them a plan, hit the plan perfectly, and update you quarterly, right?
Right.
But it doesn't always happen.
That doesn't always happen. All right. So let's move on to some other options here. So let's say we got a CEO of a decent size ISO. They currently own 100% of the business. So in their mind, they're going, oh, private equity. No. It's not going down that road. I'm not going to give up. I want to give up complete control, but I do need some outside capital. Right. What are your thoughts on that? Or what are some other ways that maybe they could look to get capital to do an acquisition, but it's not an acquisition that's going to they don't need enough capital to take over the whole business. They just want to make an acquisition.
Yeah. I mean, it sounds like more just private investment, less institutionalized. I mean, look, any sort of investment in a business involves a level of trust, right? Trust that the business is going to grow, trust that my investment is safe. So I think the best place to, find capital is to start with your own network or through warm introductions, right? These are people that can vouch for you or they understand that you're a good operator. Obviously, if that isn't an option, I really recommend utilizing an advisor, right? They are out there all day connecting you with investors and know who could be a right fit for you. I also think there's kind of a fallacy behind ownership and control, right? So someone can own a minority part of the business, you being the founder, and still have control over the day-to-day operations and major decisions like when to sell. But, if you're going to go down that path, definitely get an experienced attorney to draft these documents and really walk you through, what each term means, both from, 1,000-foot view and the day-to-day operations. And I think going back to your example with private equity, if it's private equity or if it's just one person giving you money, the biggest piece of advice I can give is to over communicate with your shareholders. Regardless of your level of control, not having alignment with your investors will always create problems, or best case scenario, a distraction, and eventually hurt the value of your business.
Yeah.
That's really good advice. What about one last kind of real technical question here, but like, what about debt versus equity financing? I mean, I know there's, mezzanine financing, there's a lot of other kind of options out there from the debt side. What's been your experience of that? And is that prevalent in our industry as well? I really haven't done a lot of deals along those lines. I'm just kind of curious your thoughts on that.
Yeah, I love debt, especially for this industry. It's based on diversified recurring revenue, right?
Right.
Debt is an amazing tool to acquire companies or get growth capital without having to obviously dilute your ownership with outside investors. I think a problem facing our industry, kind of what you just said, is there aren't really too many options. I spend a ton of my time trying to educate banks on why residual income is a very safe form of collateral, and it's tough.
Yeah.
But like you said, when it comes to debt, you have traditional banks, you have the debt funds, and you have private lenders. Rates and onerous terms usually get worse in that order. What I will say is, if a founder is taking on debt or thinking about it, it's very, very important they have a deep understanding of their budget, their forecast, and their cash flows. And ideally, you have, either someone in-house or outsource acting as a CFO to provide guidance on that.
Yeah, for sure. You can easily get yourself into trouble with that one. But the other thing
100%.
too is, you do an acquisition. It's kind of like, when we bought our last house, it's like, okay, the house cost X. Well, then you move in and you realize, oh, wow, I have to fix all these things, right? And I think in the same way you do an acquisition and kind of feel like, okay, here's the price. Well,
Yep.
yeah, but now you've got to integrate everything and there's a lot of other things. And so you could miss your projections a little bit. They could fall short. There could be friction. So yeah, you got to plan for that, right? And make sure you got the cash flow to pull it off. So, okay. Very last question I have, I think Patti has a follow-up here, but let's say that a company is listening to this and they say, okay, cool. I want to do this. I need to go down this path. I need to acquire. That needs to be part of my growth strategy. What should they do organizationally to prepare themselves to start, eventually talking to bankers, investors, PE funds, whatever? What do they need to do to get themselves in, kind of clean their house to make sure they're in a good position?
Yeah, that's great. I have a lot of people that'll approach us saying, I want to make an acquisition next month. And I say, okay, let me see your financials. And they, say, well, we only have them updated from a year ago, right? So I think the first place to start, you'd be surprised. I think the first place to start is with your financials, right? Make sure they're clean, make sure they're up to date. Audit is preferred, but at a minimum, have them reviewed by an outside CPA firm. I think for fundraising, the CEO really needs to be prepared. Obviously, you want to have, the table stakes, which is investment materials that explain the why behind the capital raise. But you also have to be prepared to work 2 full-time jobs. And I think that's often missed. Yep. Raising capital is a ton of work. And it's also the worst time for your business to go backwards, right? So you really are putting in double the work as a CEO. I think, once you do secure funding, you want to make sure you have proof of funds readily available to show a seller so they know you're serious. It's a competitive market. And I think finally, start to think through your integration plan. It's one thing to buy a company, but what does it look like to bring on a whole new set of employees? What does it look like to now potentially have product, right? There's a lot of these what ifs that you have to mentally prepare for and prepare your team for.
Yeah. And I would imagine that goes along with sort of, seeking out an acquisition target, right? I mean,
100%.
In terms of the first steps, are pretty much those same first steps need to be repeated, right?
Yeah, I mean, when you're out there searching for an acquisition target, I think it's vitally important to have a thesis, right? And going back to raising money, you want to start with your network, right? So it's impossible to look at every deal. So the more narrow and the more focused you can be on your approach, the deeper you're going to go to finding an opportunity and the less time you're going to waste looking at things that aren't a fit.
Yeah, sure.
Yeah, I like that. I think it's a really important point too. I think, you're not a PE fund. If you're listening to this, most likely you don't run a PE fund. So you're not just going to acquire a business because of their EBITDA. You're going there because there's some strategic benefit to making that acquisition. Right. And you need to be able to clearly communicate that to your investors, your shareholders, whatever it is, the bank, whoever it is you're working with, to say, here's why we're making this particular acquisition. And here's how it's going to fit into the overall strategic objectives for the company, right?
Yeah. And take it a step further. Just because you want to buy a company doesn't mean they're going to sell it to you, right? I think where a lot of founders make a mistake, and when they go to do their first acquisition, they assume the seller knows what they're up to, right? I think you need to very clearly sell the vision of what you plan to do with the acquisition to the seller. They're often parting ways with their life's work, right? This is a big deal. And then I guess, the final thing, obviously I'm biased, but my advice is to work with an advisor who can help you identify capital sources and M&A targets, right? I think in addition to that, an advisor will sit between the buyer and the seller during the negotiations. Inevitably, every negotiation gets heated. And in most cases, you're going to be working with the seller post-transaction. So it's nice to have an advisor sort of as the buffer.
Let
I like
somebody
that.
else
That's
take the heat.
good point. Yeah, I like that. So that's a great segue, actually. So, but before we, this has been so interesting. And as you said, I feel like we could probably take each of these questions and make an entire episode, right? So for those that want to learn more, they want to learn more about you, they want to learn more about MAPP Advisors, give it just a little bit of a hint of kind of like, what does that mean? I own an ISO and I say I need an advisor. What does that mean? And then where would they go to learn more and to connect with you?
Sure. No, I definitely appreciate that. We are a little bit different than most traditional investment banks. We love to meet, talk to, and work with our sellers or buyers well before they're ready to make a transaction. Because both my partner have a history running payments companies, there's a lot of levers we can help pull to sort of maximize valuation before a transaction happens. But you can visit our website, mappadvisors.com. And I really encourage anyone who wants to geek out over payments, not just transactions, to reach out to me directly. My email is alexander@mappadvisors.com.
And just to clarify, MAPP Advisors has two P's. It's
Two
MAPP
Ps.
Advisor.
Oh, excellent.
MAPP Advisors. Is that right? It's MAPP Advisors with an S on the end too, right?
Correct.
Okay, got it.
Right.
There you
I
go.
had
So
that wrong. Thank you.
mappadvisors.com, and that's alexander@mappadvisors.com. Alexander, this has been such an interesting conversation. I really appreciate you taking the time because I've been wanting to have this conversation for a while, and I really appreciate you taking the time out of your busy schedule to do it.
Of course. Thank you so much for having me on. Big fan of the show.
Hey, everybody, got another episode here brought to you by ISOAMP. Last week, I talked to you about statement analysis and how you can outsource that. But today, I really want to talk about proposal generation. These two things a lot of times get kind of put together, but they're really two different things. So statement analysis is about looking at a statement and pulling all the data from that statement, right? And then taking that data and categorizing it correctly so that a proposal can be created. Now, the statement analysis is by far the more complicated and the more frustrating, time-consuming part of the process, which is why we built software and use AI as well as human intervention to get it done as efficiently and quickly as possible. However, having the statement analyzed is not really the end result. You actually want to get a proposal. Well, with ISOAMP, we allow you to load multiple Schedule A's from multiple processors. We allow you to put margin controls in place. Any kind of margin control you want. You could say, well, I want to make sure that I always have at least 10 basis points of margin or 50 basis points of margin or whatever on a particular pricing template. You can have cash discounting, compliant surcharging, interchange plus, flat rate, tiered pricing, whatever you want. And our system works to where your team can do a proposal on any statement for any pricing. You want to go interchange plus to flat rate? No problem. You want to go flat rate to interchange plus? Now we got a problem. Nope. ISOAMP can handle that as well because we use whatever data is available on the statement to make the best assumptions and guesses that we can on the interchange cost, the card brand fees, the debit network costs, and Amex.Blue on down the list. So whatever it is that you need, you want to go interchange plus to tiered to interchange plus. You want to go compliant surcharging to interchange plus or vice versa. Whatever that is, we can handle that. And we do all of it while your team is able to see in real time using a little slider in real time. They can see the margin on the account as well as their residual split if you want them to see that information. So they do all of that. Then they access our proposal library. And so you get to choose which proposals you want them to see. Do you want to show interchange optimization? We can do that. And I'm going to talk more about that next week, but we have everything that you want from statement analysis all the way through proposal creation. We are the only trusted partner providing full service statement analysis so you can truly outsource that piece of your business and allow your payments experts to focus on what matters most, which is growing the business and closing deals. My name is James Shepard. Thank you so much for taking time to listen. Head over to getisoamp.com, GETISOAMP.com. MAPP.com to learn more. So Patti, I can't help but, play off of the interview that we just did with Alexander, because I really like Alexander, and that is a topic I'm just super passionate about. So, I have, I think, a very different opinion maybe than most in this area of growth through acquisition and acquisition in general. I actually don't think there is a right answer. And what I mean by that is, I have developed my company without the use of outside capital. Well, this company, I've developed 2 previous ones with outside capital, this one without. So no outside capital in any of the 4 companies I own right now. We've done some debt, to finance certain initiatives, but very, very minimal. So, very minimal outside capital, basically. However, I would say the vast majority of my consulting clients heavily leverage outside capital. I work with one publicly traded company. I work with several that are privately held, but most of them with a private equity firm, or using significant debt to fund growth. And so, what I think is so important here is to define your version of success. Because if you really want to do what Alexander was talking about, and you want to build a company that is trustworthy, right? Because that's so crucial. You have to have a company that's trustworthy. Otherwise, no one's going to want to acquire you, and no one's going to want to be acquired, right? But to build that out, the key is that trust really comes from the authenticity of what you're trying to accomplish. And I think too many entrepreneurs, they kind of get into this mode, and this goes for, and I say entrepreneur, this could be a salesperson, this could be, a small ISO owner, could be anybody. It's easy to get into this mode where you're just trying to make something happen.
Sure.
You wake up and you just say, I want to do something. I want to do a deal. I want to make something happen. I want to make sales. I want to hire somebody. I want to do something.
Right.
That's a very dangerous attitude to have.
Yeah.
You have to start.
I've seen a lot of it though over the years. Yeah.
Yes.
It's
One of my favorite statements is, I actually just said this to a consulting client, I think yesterday. I said, you guys, I said, I'm afraid you guys are going to spend 6 months climbing your team, building a ladder, only to realize it's leaned up against the wrong building.
Oh,
Because you got to be careful, because you have to take a step back and say, what is your version of success? And let me be really clear about this, because there are different versions, and the timeline is really, really important. So here, I'm going to give you a couple of tips really quick of just kind of how I think about things, and how I encourage my consulting clients to think about things. Number 1, think in decades, or maybe if you're just really, really super aggressive, you might think in terms of 5 or 6 years. And what I mean by that is, what can you accomplish over the next 10 years? What can you be the best at for 10 years? What can you get better and better at for 10 years? That's number 1. So you got to think in terms of decades. The biggest mistake that I talk to younger entrepreneurs, the biggest mistake they make is they think about, what am I going to do this year? Let me answer your question. Are you ready for the answer? It's always the same. I don't care who you are. What are you going to accomplish this year? Here, let me give you the answer. You ready? Not much.
right.
That's the answer, right? Especially if you're new and you say, I'm starting this business, and a year from now, we're going to be, no, you're not. 10 years from now, you could accomplish an incredible thing, but you got to be willing to put a decade of your life into something. And if you're not willing to do that, there's a couple things to be aware of. Number 1, your vision is not going to be compelling enough to get really good people to work for you. Your vision is not going to be compelling enough to get outside capital. So you have to be thinking, this is something that I'm 20 and I want to do this until I'm at least 30. I'm 30, I want to do this to 40. I'm 40, I want to do this to 50. A decade of your life into accomplishing something significant, right? What does that look like? Then, and again, you can make that mission something that is applicable today that could grow into something later. For me, making merchant sales competitive has been my mission for a very long time. And originally that meant me making free YouTube videos. That's all that was, with my little grainy webcam, right? Today, it means providing statement analysis software, training subscriptions, consulting services, building ISVs, doing all these other things.
It took a long time to build that all up.
It did. It took about a decade to get to the point where I could kind of do what I wanted to do. So, it takes a long time, and that's not just me. That's not just my experience. I talk to many, many other business owners. They say the same thing. You got to be in it for a long time. Now, having said that, then the question is, imagine your life in 10 years. What do you want it to be like? And if you want to be on the cover of, Forbes, if you want to be on the cover of the fastest growing companies, if you want to do that, you're building to bring on outside capital. That's all there is to it. You're not going to be able to compete without outside capital. So I hate to burst your bubble, but if you're trying to build a billion-dollar company over the next 10 years, it's going to be pretty challenging without some
that.
outside capital.
Yeah.
I mean, and that's just because that's the jet fuel that you need.
Right.
I have not been trying to build $1 billion company yet. We'll get to that in another decade, but I haven't done, that's not what I'm trying to do right now. Right. And so so I didn't need outside capital. So for me, when I looked at the vision for my life, it was, okay, I'm going to have a family this decade. I'm going to be spending a lot of time with my kids, with my wife, and I want to have total control over my life and total freedom to do whatever I want to do.
Mm-hmm.
Well, that says don't get outside capital because you're going to hate it. Right. So it's a different version. Now, when I built my last ISO, it was, I still want control, but I want to build this thing so I can sell it, so I can fund my future ambitions. So I use debt capital for that one. Mm-hmm. Lots of debt, so, and that's how I funded the growth of that one. Right. So it's these different things where you say, what am I really trying to accomplish? And then what are these trade-offs that I'm willing to take? So you have to think through that, right? If you're an entrepreneur and you've already built something successful, you got to ask yourself, what is the next decade's going to be like for me? Mm-hmm. Right? Am I ready to go the private equity route? The nice thing with them is a lot of times that timeline is closer to the 5-year mark, 5 to 7, but what are they looking to get out of it? But you got to say, okay, I'm going to give up some freedom, but in exchange, I'm going to have a lot of fun building this humongous thing, this big company, and doing lots of acquisitions and learning from the best in the world of business, right? If you get a good PE fund, they're going to have some very talented people on the finance side, operations side, and they're going to help you to scale your company. That's what they want you to do, is to increase the valuation. And you're going to hopefully you're going to make a ton of money. If you played your cards right, you took some money off the table, left some money in, you're going to dramatically increase the valuation through this partnership with a private equity firm and resell it. And so maybe that's your path that you're ready to go on. And you're at a place in your life where you're like, hey, I'm ready to work a lot of hours. I'm ready to make this happen. A lot of people are at that place. Then I say, go for it. Bring in the outside capital. So my message is, don't be afraid of any of the options. Don't, and I mean this both ways. There's a lot of people, and myself included, when I was in my 20s, if you would have told me that I was going to try to build a company without bringing on outside capital, I mean, when I was 26, 27, I would have thought that's a wimp. I mean, really, I didn't even understand that concept.
I get it.
What are you talking about? If I'm a real businessman, I'm going to have investors and I'm going to build something huge and I'm going to build it quick. But you
don't understand then at that point, you didn't understand what the trade-offs were.
Exactly. And when you see the trade-offs, sometimes you say, you know what? I think for the next 5-10 years of my life, I don't think I want any outside capital. And that's fine. Don't be afraid to make that decision. I can't tell you, Patti, how many people in the last 3 months, I promise you, I've had at least 2-3 people a month who are very powerful people at really big companies that have said to me, James, what are you doing? Why aren't you running $1 billion company? Why aren't you running your own processor? Why aren't you doing this and that? And I've told all of them with total confidence, that's not my mission right now. That's not what I'm trying to do. That doesn't map to my version of success right now. And when I explain it to them, they respect that. And they say, well, good for you. That's great. I love that you're spending time with your kids and your family, and let's partner someday in the future when you're ready to do that. And I say, hey, that's great. So I'm making those connections, but you have to, don't be afraid to do that. Don't be afraid of well, I don't fly private everywhere I go, and I don't have this, I don't have 100 employees, and I don't have this, and I don't have that. Don't let that get to you, right? Because you can see this person on the cover of this magazine or this person doing this, and you can think, oh my goodness, I could build that. Well, you could, but your trade-offs might not be what you wanted versus their trade-offs might have been what they did want. So don't be afraid of that, but also don't be afraid of the other side. Maybe you've been building on your own for a long time.
And it's time.
You're not feeling challenged anymore. You make tons of money, but you think, wait a second. I thought I wanted to be worth $100 million someday, and I'm worth $2 million. I'm very blessed, but I need to get to the next level. Well, if you want to get there, you might have to have some trade-offs. You might have to bring on a private equity firm that's going to push you and hold you accountable and give you the jet fuel of capital that you need to grow. And don't be afraid of that. You got to take a step back and say, what is my definition of success 5 to 10 years from now? And then make sure you're on the path day in and day out to get to that version of success. And so that's my little piece of advice as a follow-up to the interview with Alexander.
Thanks, James. So, James, consumers have been flocking to buy now, pay later. It seems to be, a lot of research and reporting. I mean, there doesn't seem to be a day, certainly not a week that passes that I don't see a story about it,
Oh, yeah, for sure.
I wanted to focus, kind of zero in on 2 reports this week. one by Forbes, the magazine, and another by an academic study by some economists at Harvard Business School and the National Bureau of Economic Research, which is a not-for-profit that's in Cambridge. So I got a feeling it's a lot of the people affiliated with Harvard. But anyway, some real notable insights. And just for background, just so everybody knows just so we're all on the same page, so to speak. Buy now, pay later market in the U.S. was estimated by the Consumer Financial Protection Bureau to encompass 180 million loans totaling more than 24 billion in 2021.
Ooh, wow.
Now, but to put this in perspective, total outstanding unsecured credit in the U.S. in 2022 was $1 trillion. So it's about 2%.
Right.
Now, there is a downside to all of this. The online websites, the online data source Statista reported that in June 2022,
okay.
There's a lot of twos here. June 2022, 22% of buy now, pay later users had fallen behind by one or more payments.
Wow.
Yeah.
So that's pretty high level
up
there.
from 16% in June of 2021, but down from 33% in February of 2022.
Wow.
Now, I'm thinking the February 2022 may have been a lot of the data from people who used it for Christmas shopping.
Sure. Yeah.
Right?
I wonder if that's interesting. I wonder if it'd be cyclical like that, where
and that's something I'm going to be looking at, because there's
I could kind of see some of the BNPL players realizing that maybe if that's the case, and maybe they start offering the January special, skip a payment kind of thing.
Yeah. Right.
Just so that it's like, keep that good relationship. Let's skip a payment if you need to,
give them a little breathing space.
I could see that.
I could see that happening. And I also wanted, so now let's go into the economic study. It was called Buy Now, Pay Later, User Characteristics and Effects on Spending Patterns. This is like a data geek's heaven, this report. It's like so much data. It's, just literally like 30 pages of it. But some of the stuff that I gleaned from that was, and this was published in August of 2022. Buy now, pay later was equal to about 2% of total credit card spend. And the user base was about 1/5 of the number of credit card users. About 16% of Americans have used buy now, pay later at least once, and 30% consider themselves persistent users.
Okay.
Now, I have to admit, James, I've been struck by this whole trend. I've been trying to wrap my head around the willingness of merchants to offer buy now, pay later, because the rates, 4 to 8% that are charged the merchants are pretty, that's like that's double what they would pay for credit card fees.
Right.
So, but then when I was looking at the Forbes survey and the data from the Harvard economists, the light bulb went off.
Okay.
Now, Forbes surveyed 1,000 Americans in November of 2022, asking them about their different uses of different financing options, generally and during the holiday season in particular. So here are some of the key reasons revealed in the Forbes article, in the Forbes research about buy now, pay later use. 64% of Americans were planning to use it to purchase holiday gifts. 70% said they would use it to spend more than they had planned.
Yeah.
And 70% would consider using it for everyday purchases, not just special purchases. The top reason for using it obviously was to reduce the impact of big purchases. Second most common reason was to purchase something that they couldn't afford right now. So that kind of goes with that.
Right.
But here's some like really additional data points that really drive home the point, just blows my mind in terms of how they, the machinations they went through, the economists went through to come up with some of this data. But basically, buy now, pay later access increases both total spending levels and the retail share of total spending by significant amounts. And this applies to consumers across the income spectrums and creditworthiness spectrums. And the increase does not just apply to buy now, pay later purchases. They said the total spending increases about $130, $130 at the time the first use. So I'm going to spend $130 more than I would have for a product if I buy it with buy now, pay later. But increased spending remains elevated for 24 weeks following. And some of that money is going to, buy now, pay later interest or late payments.
Right.
But most of it is going to retailing and other categories like essential spending and non-retail discretionary spending. So obviously, consumers have, feel like they have more spending power when they're using buy now, pay later.
Yeah.
And the merchants are willing to pay that extra amount just to get that extra money.
One of the interesting things too is I wonder how this is going to play out. You mentioned the, the merchant paying the higher fee.
Mhm.
I wonder how that's going to play out. Excuse me. I was thinking about, Apple's new BNPL.
Right.
I don't really know how the mechanics of that work behind the scenes. I mean, is that the kind of thing where the merchant is paying something, or is that just purely
To be
consumer
honest, I have
finance,
not
right?
researched the Apple one that close, but I'm assuming that the merchant's going to have to pay something for that.
Yeah, I don't know. I was kind of curious about that. I wonder, because I mean, it's one of those things where when you go through Apple Pay, you just have an option to do a BNPL,
Right.
but it's like they're not having the merchant agree to any particular fees, I don't think, as a result of that. So I'm like, or maybe that you have to be part of the network or something. I'm not sure. So that's an interesting.
I'll tell you
maybe,
what, I will do some research on that and we'll talk about that in our next Insiders Report.
I love it. Awesome. Well, thank
I'd
you,
really
Patty.
be interested in knowing, and, we can do some comparison because,
Yeah.
one of the things I think is important, there are these major companies, right? Like
Right.
Klarna and Afterpay, and what's the other one? Affirm.
Mm-hmm.
Right. But there's also some that, we've talked with Mark Beauchamp, for example,
Mm-hmm.
with his company, there are opportunities.
Oh, absolutely. 100%. And I think there's a lot of opportunities here for the ISOs. I was
That's
just
what I
talking
mean.
to,
Yeah.
I was just talking to an executive the other day from one of the big processors everybody would know. And I asked him, what is he thinking about, 2023? And he's like, oh, top of my list is BNPL. I was like, really?
Yeah.
He said, oh, it's just, huge wallet share and everything like that. And so he, big margins. So yeah, I think it's something a lot of the companies are thinking about. And there's a lot of companies that are offering various solutions. So it'll be interesting to see how that plays out for sure.
And I did some, when I was doing some research for this report, I came upon Ally Bank, which had really, a few years ago was jumpstarting its acquiring business. And now this year it's been, promoting to that business I think it's Klarna. It has an agreement with, or one of those, to offer buy now, pay later.
Well, very interesting market. I'm sure you'll keep us up to date, but thanks for the update on this one.
Sure thing.